Hello, everyone. Well, it's 10 o'clock, so we'll get started. Thank you for joining us today. I can't believe it's December already, but it is December 7th. So today we are going to talk about year-end checklist. And with us, we have Tyson Moore, who is a supervisor on our nonprofit team. He will actually be leading our webinar today. We also have Susan Berghoff, a director with our nonprofit team. And I am Carrie Minnick, a partner with our nonprofit team. So before we get started, just want to talk about a few things. The slides will be emailed out to each of you after the presentation. There will also be a recording available on our website, so we will also send you a link for that if you'd like to go back and watch it again or share with someone that maybe wasn't able to attend today. If you have questions during the webinar, feel free to use the question and answer box in Zoom, and we will be answering those throughout the webinar. We also have a chat window, so if something comes up during the webinar, maybe you can think of a best practice or want to share something, make a comment. We love to hear your feedback, so feel free to use the chat window as well. Other than that, I think I will get started and I will turn it over to Tyson.
Thanks for the introduction, Carrie, and good morning to everyone attending. Today, we're going to cover various topics that will help you to prepare for your year end. One thing to note before we start is that some of these items are going to pertain to a calendar year end, like your W-2s and your 1099s, while other items are going to be more focused on your fiscal year end, like your audit. So keep that in mind as we work through the material today. I encourage you to take notes and even start a year-end checklist if you don't already have one. As a reminder, please use the chat function to ask questions that you may have throughout the presentation. Carrie and Susan will be answering questions throughout the chat periodically. If we don't get to your question during today's webinar, we'll be sure to follow up via email. All right, so here's a roadmap for what we're going to cover in today's webinar. We're going to give a light overview of each topic just to get you thinking about possible items that need to be done at your year end. We're going to start with some new accounting standards. This will include the contributed non-financial assets standard and the new lease standard. We'll talk about sending thank you letters, included the timing and what should be included in those letters. Talk about collecting items needed for your 1099s, like your W-9 form. Talk about preparing your W-2s, reminding your employees about W-4s, preparing your annual 990, approving and reviewing your internal policies, preparing next year's budget, filing reports required by grantors, filing your property taxes, filing an E-1 if it's needed, and then we're going to finish with scheduling your annual audit. Like I said earlier, some of these items are going to be done at your calendar year end, like your W-2s, while other items are going to be done during your fiscal year end, like budgeting and scheduling your audit. We're going to start with some new standards, and the first one we'll touch on is contributed non-financial assets. This is basically your in-kind standard. It goes into effect for annual reporting periods starting after June 15th of 21. This means if you have a June year end and you want to adopt the standard on June 22 statements, and if you have a December year end, you're going to adopt this during your upcoming audit. The most drastic change from previous in-kind rules is that donations will need to be reported by type of asset rather than reported in aggregate. This rule also requires you to report gifts of in-kind donations as a separate line item in the statement of activities. You must also disclose whether your organization plans to sell or use each in-kind donation, any donor restrictions on the in-kind donations, and how you calculate the value of your in-kind donations. So keep in mind that there could be more questions from your auditor about in-kind during your upcoming audit. Also, if you present your financial statements on a 2-year comparative basis, your auditor may need to ask additional questions about your prior years in-kind as well. One additional thing to note here, investments do not fall into this category. They're considered financial instruments. So they don't fall under this new standard. Also, digital currency, things like Bitcoin and Ethereum, they're considered intangible assets and also don't fall under this new standard. Next, we're going to talk about leases. The new standard ASC 842 will take effect for periods beginning after December 15th of 21. And the purpose of this is really to disclose and increase the visibility of your lease obligations. The new standard is going to require that most leases that last longer than a year to be recorded both as an asset and a liability on your statement of financial position as opposed to being expensed. To qualify as a lease under this new standard, the agreement must be non-cancelable and for more than 12 months. In addition, the lease must be for physical assets, so things like office space, copiers, vehicles, equipment, things like that. Intangible items like software are not considered physical assets and therefore do not fall under the standards. Some not-for-profits receive below market leases or fully donated leases. When a lease agreement's payments are below the fair market value of a property, the portion of the lease paid would fall under the new standard, with the difference being recognized as in-kind contribution. Fully donated leases should be recorded as a contribution receivable and a net asset with donor restrictions. So what if you follow the cash basis or the modified cash basis? If your organization follows the cash basis or the modified cash basis, the new lease standard may not apply. If you're on the cash basis, since accounting is only going to report cash and net assets, this update's not going to apply to you. But for organizations following the modified cash basis of accounting, you're going to need to use judgment when determining whether this update is going to apply for your organization or not. If you report fixed assets and the related debt to obtain fixed assets, this update probably is going to apply to your organization. One thing to consider with this new change is that if you have loan covenants that revolve around assets and liabilities, they may be impacted by this new standard. So the best thing you can do as an organization to get ready for this new lease standard is make sure that you have all of your leases on hand and up to date. If you're not sure what leases your organization may have, it's good practice to review your general ledger. Look for any recurring monthly payments that could possibly be considered a lease. Next, we'll talk about sending thank you letters to donors for their support. So a taxpayer must be able to substantiate a charitable contribution to receive a donation on their tax return. The IRS states that contributions of $250 or more require written contemporaneous acknowledgement from the not-for-profit. All right, so what's contemporaneous mean? This means existing or occurring in the same period of time. So as a not-for-profit, you're required to give the donor written documentation in the same tax period as the donation was given. This acknowledgement should include the nonprofit's name, the date of the contribution, the amount of cash, and a description of any other property that was contributed. A statement noting whether the organization provided any goods or services in return for the contribution. And if goods and services were provided, you should add a description and a good faith estimate of the value of the items received. These acknowledgements must be issued by the filing date of the donor's tax return for the year of the donation. There is one exception here to the $250 acknowledgement rule, and that's quid pro quo contributions. These require that an acknowledgement of any contribution over $75. So a quid pro quo contribution is money that was given partly as a contribution and partly for services. For example, let's say a donor gives you $100 and receives a ticket to a concert valued at $40. In this example, the contribution portion is $60, but because the total payment was over $75, an acknowledgement would need to be issued. Keep in mind, there is a penalty of $10 per contribution that is imposed for failing to make the required disclosures. Next, if you haven't already done so throughout the year, you're going to need to collect information to issue 1099 forms. So the IRS introduced a new 1099 in 2020. It's Form 1099 NEC for non-employee compensation. Form 1099 NEC is used to report non-employee compensation, whereas the old Form 1099 MISC is used to report other miscellaneous payments. So what's included on the 1099 MISC? That's going to include things like rent, prizes and awards, other income payments, fishing boat proceeds, if you have any of those, medical and healthcare payments, crop insurance, payments to an attorney, Section 409A deferrals, and non-qualified deferred compensation. All right, so what goes on the 1099 NEC then? Well, these are going to be issued for total payments to vendors that exceed $600 and services performed by someone who is not your employee. We're going to talk about an employee versus an independent contractor here in a moment, so bear with me on that one. Also included on the 1099 NEC is payments to an attorney. The most common exceptions for both 1099 MISC and 1099 NEC are payments to a corporation. These generally do not need to be reported. However, payments to attorneys that are corporations must still be reported. So one of these forms is required to be filed. Well, the 1099 MISC must be filed with the IRS by March 1st if you're going to file on paper, or March 31st if you file electronically. You must also provide statements to the recipient by January 31st. One thing to note here is you can only file your 1099s on paper if you're filing less than 250 forms. So 1099 NEC, this must be filed with the IRS by February 1st, whether it's paper or electronic. And you must also provide a statement to the recipient, just like the 1099 MISC on January 31st. To make sure your organization has all the required information needed for 1099s, be sure that you request W-9 forms throughout the year from all independent contractors before you make any payments. If you're not quite sure if a vendor is going to need a 1099 at the end of the year or not, it's better to have them fill out a W-9 before payment, just in case for your records. So what is this W-9 form? Well, this form has all the information needed to complete your 1099s. And we're often asked, what do you do if you can't get a W-9 form or you're missing certain information to prepare your 1099s? So if you're missing an EIN or a social security number needed to complete your 1099s, best practices are to submit your 1099s without the missing information and then later amend the returns when you actually get the information. Next, we'll talk about preparing your W-2s and other annual payroll returns. We'll start with your WH-3. This is your annual withholding tax form. All employers that withhold state or county income tax from employees must file Form WH-3 annually. This form shows the accumulated amount of state and county tax withheld for the year, and the employer may have taxes due depending on withholdings made or paid during the year. You also may need to file a 940 for payments of FUTA taxes. This may be this isn't true if you're a 501c3 organization, though. The due date on the 940 is January 31st. However, if you deposited all your FUTA tax during the year, then it's not due till February 10th. So keep that in mind. And I'm going to say this one more time. All 501c3 organizations are exempt from FUTA and don't need to file a 940 at the end of the year. Next, we'll touch on W-2s just for a moment. So any employer who pays for services performed by an employee must file Form W-2 for each employee. The form provides a summary of the employee's salary, payroll taxes for the year. Specific copies of the W-2 must be filed by the employer with the IRS, the Social Security Administration, and the state. And a copy must also be provided to each employee. I often get asked if things like fringe benefits, so health insurance, workers' comp, retirement plans, things like that, also gift cards, should these items be added to the W-2 as wages? And the IRS is very clear, all fringe benefits and gift cards paid to employees should be included as wages on Form W-2. So let's talk a little bit about an independent contractor versus an employee and how to differentiate between the two. Well, the biggest one is behavioral control. So does your organization have the right to control how the individual does their work? Are there specific instructions given on how, when, and where to do the work? And are there specific tools and equipment that are needed to do the job? Does the organization provide training on the required procedures to perform the work? Another big one is financial control. So does the organization control the business aspects of the individual's job? And lastly is the relationship. What type of relationship exists between the organization and the individual? Does the individual receive benefits, things like retirement, insurance from the organization? And is the expectation that the relationship will continue indefinitely or only for a specific project or specific period? So make sure you keep all these in mind when you're classifying workers between an employee and an independent contractor. Next, this is kind of related to our payroll items. We're going to talk about W-4s. and talking to your employees about maybe making updates to their W-4s. So what is the W-4 used for? It walks the employee through a series of calculations that will tell the employer how much to withhold for federal income tax purposes. There was a restructuring done of the W-4 in 2020, and these new changes came from the Tax Cuts and Jobs Act. And instead of basing the amount of withholding on allowances, like what was done before, the new W-4 considers multiple jobs, number of dependents, and other income and deductions. The form now basically has you do an estimated 1040 for the most part to try to get down to the correct numbers. So employees should complete a new W-4 for significant life changes. So things such as a change in marital status, birth of a child, getting a substantial raise, adding a second job, a change in a spouse's job, or after completing their taxes, they find that not enough taxes are being withheld. And it's a good practice to send an email out or some kind of communication every year to employees just to let them know the reasons that they might want to file a W-4 with you, and also your internal processes for completing an updated W-4. Next, we'll talk about filing your annual Form 990, or maybe you need to gather information to provide to your CPA to prepare your 990. So nonprofit organizations are tax exempt. They do not file income tax returns. However, the IRS still wants to know information on a nonprofit's programs and activities, and therefore requires a nonprofit to file informational returns. Keep in mind that churches and certain church-related organizations are not required to file information returns, but most other tax-exempt organizations are required to file. So let's talk about the 3 different levels of 990s that you might need to do. We'll start with the smallest level, which is a 990N. It's called a postcard because it's basically 1-page form. This is if you have gross receipts that are normally less than or equal to $50,000. And IRC Section 527 political organizations and Section 50983 supporting organizations are not eligible to file a 990N. They must file a 990EZ at least. All 990Ns are filed electronically now with the IRS, and they ask for very basic information. So your annual tax year, the name of your organization, ask for your address, an employee identification number. It asks to add a website if you have one, and the name of and the address of your principal officer. And lastly, there's a checkbox that says normally you have gross receipts less than $50,000. The next step up is a 990EZ. This is called the short form. It's if you have gross receipts less than $200,000 and total assets less than $500,000. The 990EZ includes everything on the 990N, but also includes exempt and other activities. It includes your full finances, has compliance in certain federal, state filings and requirements, and it talks about compensation paid to certain people within your organization. There's also additional schedules that could be added depending on activities within your organization. And keep in mind here, if you do qualify for a 990EZ, you have the option to file the full 990 if you wish. And lastly, we'll talk about the full 990. So this is if gross receipts are greater than or equal to $200,000 or your total assets are greater than $500,000. It has additional questions on board activities, legal requirements, and ethics. The full 990 focuses on transparency and encourages compliance throughout the organization. It's an 11-page core return, but there are 16 potential schedules that could be added based on activities of your organization. It's due on the 15th day of the 5th month after your organization's accounting period ends. This is for all types of 990s are due on the 15th day of the 5th month. And remember, all 990s must be e-filed with the IRS. There's no paper returns that are accepted. You may also request a 6-month extension by filing Form 8868. This is called the application of extension of time to file for an exempt organization. But make sure that you have to have this filed by your normal 990 filing deadlines. Keep that in mind. An incomplete return filed is the same as not filing a return at all with the IRS. And failure to file a return by the required due date results in penalties of $20 per day, up to $10,000, or 5% of the organization's gross receipts for the tax year. If your annual receipts are greater than $1 million, the penalty is $100 a day, up to $50,000 per return. So the moral of the story here is be sure to file your 990 on time. And along with your 990, if you're sales tax exempt in the state of Indiana, Form NP20 is required to be filed with the state of Indiana. And there's been some recent changes there. So in the past, nonprofit organizations were required to file an NP20 each year with the Indiana Department of Revenue to maintain their sales tax exemption. This form could be filed on paper or electronically. And organizations still need to file an NP20 for the 2021 tax year that will be due in 22. However, after filing the NP20 due in 22, the NP20 will no longer be filed. Form NP20R will now be required to be filed every 5 years instead of annually. And here's how you figure out what your next filing date is going to be. So if you look at this slide, it's basically based on your EIN, so you can kind of see where you fall in line there. And after the date shown above, your next NP20R will be due on May 15th every 5 years. So now is a good time to look at the timing of this. It's going to be a little confusing, and try to figure out the timing for your specific organization, and maybe think about putting something in place that's going to remind you 5 years from now to get this filed. We're not quite sure if the state of Indiana is going to send out reminders or not on this. So try to make sure you can remember that 5 years from now. Also, Form NP20R must be filed electronically now through an organization's in-time account with the state. If your organization does not currently have an in-time account, now might be a good time to work on getting one of those set up. Be sure to also clarify with the person who normally files your NP20 to determine if they're going to be filing this going forward still. If an outside source prepares your NP20 and will continue to do so every 5 years, they're going to need access to your in-time account. Indiana also chose to make some other changes regarding paying sales tax when it comes to not-for-profits. So there used to be a 30-day rule in place saying that if you sold tangible items for not more than 30 days in a calendar year, you were exempt from paying sales tax. Beginning July 1 of 22, the 30-day rule was repealed and replaced. And instead of a 30-day rule, there is now a $20,000 rule. So it's $20,000 in a calendar year. So if our organization sells items and has $20,000 or more in sales during the calendar year, you must collect and remit sales tax now. There's no change to the items that are being taxed under the new $20,000 rule. For example, the sale of periodicals or books that are intended to primarily further the educational, cultural, or religious purposes of an organization are still exempt under these new rules. So just be aware that there are some organizations that may need to start paying sales tax that never had to before based on these new rules. One more change regarding sales tax in Indiana is to Form ST 105. Beginning January 1, 2023, new exemption certificates are no longer going to be mailed and will only be available through an in-time account. You should no longer use Form ST 105 because the options for nonprofits will be removed. You will need to go through in-time to request Form NP1 as a replacement for the old ST 105s. They did state that previously issued ST 105s will remain valid though. This is yet another really good reason to make sure you have an in-time account set up at indiana.gov. One more thing to note is that all these items coming from the state of Indiana, there still needs to be some clarification done on some of these items. So look for updates via our Mission Minded blog as new information is released. Next, we'll talk about reviewing your internal policies. So year-end is a great time to look at internal policy and assure that they're all relevant and up to date. I know we've talked about this in other webinars, but I want to talk about the 3 required policies. So you need a conflict of interest policy, a document retention and destruction policy, and a whistleblower policy. But there are a few other policies that you should review to assure that they're up to date every year. One is your capitalization policy. So this policy should include a threshold for capitalizing items versus expensing them. Most organizations set a dollar amount of $500, $1,000, or maybe $5,000 based on the size of the organization. But any number can really be used here as long as it's reasonable and applied consistently. Another thing that should be included in this policy is how to handle multiple small items that are purchased at one time. So for example, let's say your capitalization policy is $1,000 and you buy 3 laptops at $500 a piece. So the total is $1,500. Should this amount be capitalized because the total is over $1,000 or expensed because each laptop is $500? Addressing this will help to assure that all items are capitalized on a consistent basis throughout the year. Another one to look at is your gift acceptance policy. This policy should address what items your organization is willing to accept via donation. This will take all the guesswork out of accepting future donations of items other than cash. For example, would your organization accept a donation of an old decaying building? The answer might be no, just because it could be more of a liability to upkeep this property, especially if your organization doesn't really have a need for more space. I've seen some organizations accept gifts that end up becoming a burden for the organization. So make sure you're very intentional and thoughtful when creating this policy. Another item that should be addressed here is digital currency, such as Bitcoin. We're starting to see locally some donations of Bitcoin, and most organizations don't address digital currency at all in their gift acceptance policy. So that's something to think about here. Lastly, we're going to talk about an internet and a technology policy. So if you don't have one of these already, it can be a vital plan to the healthy organization. Let's talk about the steps needed to create a technology plan. Technology plan basically addresses how your organization will use technology to accomplish its missions and its goals. An effective nonprofit technology plan should serve 3 useful resources. So it should create a strategy for using your existing technology in the most efficient ways. It should build a roadmap or a schedule for making planned upgrades or new purchases. And it should lay out a contingency plan for unexpected tech failures in the future. Once you've decided to create a technology plan, the first thing you should do is review your current technology. This involves taking a full inventory of all hardware and software that your organization uses. So how many computers do you own? What operating systems and software packages do you have installed? What accounting, volunteer, and donor software do you use? And what procedures do you have in place for security and backing up this data? Now that you have a real clear understanding of your current technology, the next step is assessing where improvements might be made. So do you have enough computers? Is your software up to date, or is any new software going to be needed? Is everyone properly trained to use your current systems in the best way? Asking these questions will help to uncover your current technology weaknesses. And the next step is to look at your budget, decide how much should be dedicated to technology. Should you set aside operating funds for technology purchases? Are there any grant opportunities for technology? Be sure when you get to this point that you start to create a wish list. Make sure you prioritize this list so the most important needs are met first. So this should include short-term items like purchasing a new computer or software, but should also look at longer-term goals like maybe replacing a server down the road. The next step is implementation. And be sure you lay out a timeline for adding new hardware or software. And select which vendors that you're going to use in the process. Remember that there could be some downtime during this step, so be sure you plan ahead for the transition. And the last and sometimes overlooked step is evaluation. So once you have implemented everything's complete, running smoothly, be sure to take the time to review your new technology and make sure it's actually doing what you plan for it to do. A few things to keep in mind here. When creating a technology plan, with more remote work being done over the last few years, there's going to be more wear and tear on your technology, and they're probably going to need to be replaced faster than they ever have been before. Also, if you're thinking about buying software and you're a tax-exempt 501c3 organization, consider using TechSoup. They sell discounted software specifically for not-for-profit clients. And your technology plan will kind of lead into this next checklist item, which is preparing next year's budget. So all nonprofit organizations should have a budget that identifies the expected revenue and expenses for the upcoming year. A budget is a plan that allows your organization to determine where its resources are coming from and what to do with those resources. Oftentimes, the budget is created looking at what has happened in previous years and adjusting those balances for what is expected to happen in the future. This isn't the only way to create a budget, but we find it's sometimes the easiest and most efficient way to do it. So some questions you might want to ask. Are there any programming that will be cut during the coming year? Are any new programs that the organization is going to take on? Has the organization lost any of its funding sources, or are there any new funding sources in the horizons? How many individuals are you expected to serve during the next year? Management should really ask itself what will be different in the upcoming year from the previous year and adjust a budget accordingly for these changes. Also, be sure that your budget has been prepared and approved by your board before the start of your fiscal year. Most organizations typically try to prepare a balanced budget where income equals expenses. And sometimes a balanced budget is appropriate, but healthy organizations do require cash reserves. Sometimes an organization will need to increase its cash reserves or need additional cash to pay down its debt. In these instances, the organization may plan to generate more income than expenses, creating a surplus. Other times, the organization may feel that the reserves are more than sufficient and decide to invest extra funding in new programming or maybe give out one-time pay raises to employees. In instances where there's a deficit budget, when expenses exceed income, it's important to make sure that the deficit was expected and not just an error in budgeting. Once a budget is prepared, it should be approved by the board of directors prior to the start of the fiscal year. So I've said that twice. That's really important. It gets approved prior to the start of your fiscal year. When a board approves a budget, it's really approving the use of the resources for specific purposes. After the budget is approved, the board should continue to make use of the budget by comparing actual results to budgeted amounts on a regular basis to ensure spending is in line with the approved plan. While reviewing budget versus actual, be sure to analyze and make changes during the year based on this data. It's too often I see organizations who review this data monthly and never really use it to make changes. It's okay to change the initial course of action mid-year if things aren't going the way that you predicted during the budgeting process. When you move through the year and your revenue numbers look to be trending significantly below budget, it may be a good time to look at places to cut budgeted spending. Remember, a budget is a tool that should be used all year long as a financial guide and should help the organization to make difficult decisions along the way. Next, we'll talk about reports that may be required by your grantors. I'm going to talk about some general items that funders may require, but make sure you become familiar with what each grantor wants to see and provide them with everything that they ask. So these reports are a formal way for you to update your funders on what you've accomplished with their grant money during the year. Many funders have some grant reporting guidelines, so if a grantor gives you a list, make sure you provide everything that they ask for. If no specific list is given, here are some general items that you might want to include in a grant report. So you should include grant activities. This should talk about what you propose to do with the grant money and the activities implemented during the granting period. It should include your outcomes and impacts, data that shows the difference the project has made in the community. Make sure it's not all numbers. So I love numbers as much as the next guy, but be sure to present both financial and non-financial measures. Also include any changes in the initial grant proposal. So why and how the changes you made improved the project, along with any challenges and lessons that you learned along the way. And lastly, make sure to include all your financial information. This should include details on how the grant money was spent during the reporting period. So next we'll talk about filing your property taxes. Although a 501c3 organization does not pay property taxes on an annual property tax return, it is still required to be filed May 15th of 2023. Note that there are still penalties for not filing a property tax return in a timely manner. There's a $25 fee assessed to any return filed after May 15th. This return should include all of the fixed assets of the organization as of January 1, 2023. If you rely on an outside source to prepare your property tax return, and you're not on a 12/31 year end, you'll need to provide updated fixed asset information to the person who's going to complete your property tax return. Certain property that is owned, occupied, and used predominantly for charitable, religious, or educational purposes may be exempt from property tax in Indiana. However, in order to be exempt, nonprofits must file an exemption with the when the property is purchased. If an organization relocates, they must file a new exemption for the property at the new location. Once they receive the exemption, they still need to file an annual property tax return every year. Exemptions are only required to be filed one time and must be filed for all properties that the not-for-profit owns or holds personal property at, and must be filed by April 1st of the first year the location is used. If your property is moved to a new location, a new exemption should be filed for that location. An exemption is requested using Form 136, and the items needed to file Form 136 are your organization bylaws, your article of incorporation, financial statements for the 3 previous years, and a property tax card. If you're not quite sure if Form 136 has been filed or you need to complete this form, contact anyone on our not-for-profit team. We can definitely help you with that. So if your organization receives any funding from government sources, you're going to need to file Form E1. It's an annual report with the State Board of Accounts. This is due 60 days from your year end. The State Board of Accounts is responsible for the examination of the records and accounts of entities receiving financial assistance from governmental sources. This includes making sure all entities receiving financial assistance from state or local government sources have an audit performed in accordance with agency guidelines. Indiana code requires the audit of any entity when the public funds dispersed are equal to or greater than 50% of the entity's total disbursements. All non-governmental organizations receiving financial assistance from government sources are required to file an E1 with the State Board of Accounts annually. This is due 60 days after the year end. Form E1 should be filed online in the Indiana Gateway. This form is used by the State Board of Accounts to determine whether the organization is required to undergo an audit. It asks for basic information about the organization. So your year end, an EIN, address and phone number, a list of officers and the type of organization and your legal status, and the details of government funds that were received and dispersed during the year, along with your total disbursements. So government funds include all cash received, so grants, contracts, subsidies, contributions, reimbursements, and loans from the federal government and any state or local governments. It also includes any in-kind given by the federal government. So on Form E1, government funds can be reported in 4 different categories. The first is direct federal grants. This is federal funds received directly from a federal agency. The second pot is federal grants passed through state or local governments or other nonprofits. These are grants that were first received by the state agency or a local unit of government or another not-for-profit and then subgranted to your organization. The third pot is fee for service. These are when a government agency reimburses your organization based on a specific per diem or per unit rate for services provided. And the last pot is state and local. This is all non-federal funds received from a state or local unit of government and also includes contracts to provide services for a flat rate fee or contract amount. Remember that these are not fee for services and should be recorded as state and local if they come from state and local agencies. Once submitted, you're going to receive an email noting whether your organization is going to be required to undergo an audit or if an audit has been waived. If an audit is needed, you will be required to submit a copy of the auditor's contract to the State Board of Accounts for approval. Upon completion of the audit, you will also be required to notify the State Board of Accounts the date, the time, and the location of your audit exit conference, and submit a copy of your final audit report. This leads into our last section, which is scheduling your annual audit. So first, I'm going to talk a little bit about a compilation, a review, and an audit, and some of the differences between the 3 levels of service. We'll start with a compilation, which provides no assurance. There's wording in a compilation report that says we have not audited or reviewed the accompanying financial statements, and accordingly, we do not express any opinion or provide any assurance about whether the statements are in accordance with generally accepted accounting principles. A compilation involves taking the numbers provided by a client and creating financial statements. There may be some adjustments done through the process if certain items look out of place, but no real testing is done on any of these numbers. The next level up is a review. A review provides limited assurance. You'll see wording in a review report that says, based on our review, we are not aware of any material modifications that should be made to the accompanying financial statements in order for them to be in conformity with accounting principles generally accepted in the US. So a review is going to include inquiries of management and staff and analytical procedures. So analytical procedures are looking at financial and non-financial measures just to make sure that they agree with each other. This may be comparing clients served to your program expenses, and generally we're going to expect these two numbers to move up and down together. If they don't, that's kind of when we go back to inquiries of management. So if those don't move in the right way, we'll talk to management and try to figure out if it's reasonable, but they didn't. The next level up is an audit. An audit's going to provide reasonable but not absolute assurance that your financial statements were fairly presented in accordance with GAAP. So an audit procedures include inquiry and analytical procedures like in a review, but also require the auditors to gain an understanding of the organization's internal controls. Also requires sending out confirmation on balances to outside sources. So an audit's not just trusting information provided internally by a client, but it's going one step further and looking at invoices and confirmations from outside of the organization as well. You're going to see wording in an audit report that says, in our opinion, the financial statements present fairly in all material respects the organization's financial position in conformity with generally accepted accounting principles. So what reasons might you need to have an audit? Well, it could be required by the Federal Office of Management and Budget. This is if you expend over $750,000 in federal funds during the year. This triggers what's called a single audit, which combines annual financial statement audit with additional testing that's done specifically on the federal funds received. It could also be required, like we talked before, by the state of Indiana when you file your E-1. It could be required by banks if you have loans through them. It could also be required by funders before they're going to provide grant money. Could also be required by your board of directors or maybe even in your bylaws. But one thing to note here is that if you're thinking about having a first-time audit and it isn't necessarily required by one of the sources listed here, having a review for the first year may be the way to go. So if the reviewer knows that an audit is upcoming in the future, they can make suggestions on certain things to change, certain processes to update, so your organization can be more prepared the next year going into an audit. So what are some audit best practices? So once you've decided that an audit is going to be required, what are your responsibilities as the client? Well, you're going to be responsible for internal controls, making sure those are in place, following all accounting principles, preventing and detecting fraud and informing your auditors of any fraud, compliance with local laws and regulations, and assuming all other management responsibilities. Okay, so that's what the client's required to do. What are the auditor responsibilities during an audit? Well, we establish an understanding of services. We're required to be independent from the client. We have to follow generally accepted auditing standards. We have to obtain reasonable assurance that your financials are not misstated. We have to evaluate the appropriateness of the accounting policies that are used and the reasonableness of estimates. We have to consider your internal controls, but it's not our job to find fraud. It's not really what an audit's designed to do. There's kind of a misconception there. So what do auditors do? Well, we properly plan an audit. We do a risk assessment to determine what areas of your audit are more risky. We determine a materiality, which is a threshold for financial statement misstatement. We obtain an understanding of your organization's accounting systems and your policies. We do team discussions, which is a meeting between staff that'll be working on the engagement to get a better overall understanding of your organization. And what audit procedures are going to be performed during an audit? Well, we inspect documents. So we review your records and documents. We do observations. So this would be done on items like inventory, where we're going to watch an inventory being counted. We'll do inquiry, which is questions of management and other staff. We'll send out confirmations, which can be done on bank balances or sometimes even receivable balances. We'll do recalculations, which is checking the accuracy of math done on different schedules provided by a client. We'll do reperformance. This involves walking through processes within the organization and making sure that all controls are being followed as they should be. And we'll also do analytical procedures. This involves looking at the relationship between both financial and non-financial measures, making sure that they appear reasonable. So what is an auditor looking for when they do these procedures? Well, we're looking for existence and occurrence. So do you really have the assets on your balance sheet? Let's say. We're looking for completeness. Do your financial statements include all transactions for the year? We're looking at rights and obligations. So do you really own the rights to your assets and liabilities that are recorded on your financial statements? We look at classification. So are all items included in the correct categories on the financial statements? We look at valuation. So are all items valued properly? This becomes really important with items like in-kind that don't necessarily come with a price attached to them. We also look at cutoff. So are all transactions included in the correct accounting period? So as a client going into an audit, how can you best prepare to have an audit done? Well, you can make sure you have documentation ready to go for your auditors. One of the most important steps is that an organization can take is having your accounting records up to date, accurate, organized, that kind of thing. Oftentimes, an auditor will provide the organization with a list of items needed for the audit. By providing these items to your auditor at the beginning of audit field work in an organized manner, it will reduce the number of times your auditor will have to ask for additional information. May reconcile all your accounts. This may seem obvious, but make sure all of your bank accounts have been reconciled to both the bank statement and the trial balance. Also, make sure significant accounts listed on your trial balance have proper supporting schedules that agree to your trial balance. Make sure you take an inventory of all your fixed assets. Did you make any new fixed asset purchases during the year? Did you dispose of any fixed assets? Make sure you take an inventory of all your fixed assets at year end and update your fixed asset listing for any current year activity. Make sure you inform your auditor of unusual items. So did anything unusual happen during the year? Did you receive unusual sources of revenue? You weren't quite sure where to put it, so you recorded it in contributions, let's say. Did you have any odd expenses that were put to miscellaneous expense, or maybe you buried them in program expenses? Tell your auditors of anything unusual that happened during the year at the start of the audit. We also recommend that you talk with us throughout the year if you have unusual items. It's often much easier to talk with us and record an entry correctly during the year than it is to fix mistakes during the audit process. Be sure you review your internal controls. As part of the audit procedures, auditors are going to need to understand your organization's internal controls. Make sure you have internal controls documented and review them each year for any changes. This will save you from having to get these updated during the audit while you're trying to pull all kinds of other financial information. And be sure you're available for questions during the audit. So the length of field work for an audit could vary. It could be up to several days. During the time, the auditors may need to ask questions. It's important that key employees are available during the time the auditors are in your office so that field work is not held up. Also, if the audit is done remotely, be sure to respond to emails and phone calls in a timely manner. All right, so now that we've reviewed many items that may need to be on a year-end checklist, here's a quick example of what your checklist should look like or could look like. And there are a few things to note here. Make sure you add due dates to your checklist so everyone knows when these items are due and that no due date is missed. Be sure to number this list based on the due date. This is important to assure that you're working on the most important time-sensitive items first. I also suggest adding which employee is responsible for each item. This helps to assign tasks and helps to make sure that not one person is solely responsible for everything at year end, and make sure that one person isn't completely overloaded. Also note where different files might be located. See the example I added where the prior year budget and W-9s are located. This will make sure that everyone knows how to find these items and makes completing each item more efficient. This is important in case of employee turnover. This list should be detailed enough that a new employee could complete everything on the list. Keep in mind that a year-end checklist is a working document, so it should be reviewed and updated every year. All right, so now we've covered your most important items that you should be reviewing when approaching your year end. Make sure your organization creates a year-end checklist. It is tailored specific to the needs of your organization. This checklist should be numbered and based on due date and be detailed enough that someone new to your organization could complete all items if needed. Remember, year-end checklist can be a vital source in ensuring that nothing goes undone during your annual year-end close. All right, Carrie, Susan, any unanswered questions in the chat? I didn't get a chance to look at those
No,
yet.
I think we answered all the questions. Thank you,
Okay.
Tyson. We went over a lot of information today, so if you have questions, please feel free to contact us. Again, Tyson's slides will be emailed out to all of you, along with a link to a recording of this webinar that's on our website. If you haven't visited our website, I encourage you to do that. It's dwdcpa.com. You can find recordings of our previous webinars as well. We will be continuing our monthly nonprofit webinars in 2023. We're currently kind of going through and figuring out what topics we want to talk about. So if there are topics or information that you just really want to know more information about, please feel free to contact us, because again, the reason that we're doing this is to help you. So we want to answer your questions and make sure that you are getting the information that you need. So with that, and also all of our, Susan, Tyson, and myself, our emails and information, phone numbers are listed on the website. So again, feel free to contact any of us as well as Phil. He was unable to join us today, but he's also another member of our nonprofit team. So again, just want to thank you for all that you do for your nonprofit in the community, and thank you for joining us today.